Now, the trouble in the Eurozone has been bubbling away. Spain's Prime Minister Mariano Rajoy has said that his country must urgently reduce its deficit in order to meet economy targets set by the European Union. Concern is growing over Spain's ability to cut its national debt and lift its stagnating economy out of recession, especially with unemployment at such a high level, 23%. Well, meanwhile, in Italy, borrowing costs more than doubled in a pair of bond auctions. The borrowing rates of Italy had eased in recent months after the ECB gave banks emergency loans and Mario Monti's government implemented austerity measures. But uncertainty has returned to Europe, pushing rates higher. So has the Eurozone debt crisis returned with a vengeance? Well, Martin Koehring is an economist at the Economist Intelligence Unit and joins me now from our central London studio. What do you think?
Well, actually, the Eurozone crisis has never gone away. I mean, we said for a while that there are lots of issues that haven't been resolved. I mean, for example, if you look at Spain, it's really a debt spiral that is affecting Spain. I mean, there's no growth. We expect a contraction in the economy again this year of up to 2%. Without growth, the debt will just rise. And then we have the problem with the banks in Spain, the cajas, the savings banks. They're highly indebted. And the government has nationalized some of them and is in the process of restructuring them. So that adds to the government debt. And then we have the problem of the regional governments in Spain, which is responsible for education and health spending as well. And the government isn't really in control of what the local governments do. So the government has really lost control over what's happening in the country. They can say a lot. I mean, they're saying that they will cut the budget by 27 billion this year and up to 55 billion including next year, but they won't be able to implement it.
I mean, the government is under a lot of pressure, and there's also pressure on the wider Eurozone, isn't there? Because Spain makes up 11% of GDP in the Eurozone. Compared to Greece, which just makes up 2%, it's a pretty big deal if things really do go pear-shaped.
Yes, you're right. I mean, if you look at Spain and Italy, their economies are much larger than Portugal, Ireland, and Greece. I mean, these countries are really too big to fail, and we know what happened to the banks that were too big to fail. They were bailed out. So it's very likely that the Eurozone will now increasingly come under pressure to bail out these economies as well. I mean, there are three things really that haven't been sorted out. First of all, the firewall that has been put around the Eurozone is only big enough really to sort out Ireland, Greece and Portugal, but not big enough to help Spain and Italy. And then there's no debt instrument, a common debt instrument such as Eurobonds that would, so that countries such as Italy and Spain would benefit from Germany's creditworthiness. That hasn't been put in place. And also there's been no rebalancing of growth. So for example, Germany is not doing enough currently to spur growth in other economies, for example, by importing more. So these three things haven't been sorted out, and as long as that's not happening, I don't think there will be any solution to the Eurozone crisis anytime soon.
And of course, that's the key, isn't it? It's growth that we need to see within the Eurozone, particularly in the weaker southern economies.
Yes, exactly. I mean, fiscal austerity is only detrimental to growth in the short term. Of course, in the long term, a lot of things are happening that are very beneficial. Structural reform, for example, to the labor markets, making labor contracts more flexible. In Spain, the big problem is unemployment 23%, youth unemployment 50%. So in the medium to long term, the things that are happening are very important. But in the short term, there have to be mechanisms such as Eurobonds, bigger firewall, Germany helping these economies by spurring growth, or maybe such as like a Marshall Plan, a major investment program, a new Marshall Plan for Europe, something that can help these economies in the short term. As long as this is not happening, government bond yields and debt concerns will just remain a big issue in Europe.
I wanted to talk to you about the bond yields actually, because we have seen the softening of bond yields today after rises in the last few days. What does that tell us about what investors are thinking right now about the state of these economies and how they're being dealt with?
Well, there's still lots of concern, particularly about Italy, which has, I mean, their debt burden is very high. I mean, it's the biggest in the Eurozone after Greece. And Spain is the private sector debt. I mean, the private sector debt is around 4 times as big as the public sector debt in Spain. And this private sector debt, that's the banks, the households and companies, is slowly moving towards the public sector because the public sector is taking over the banks and the property sector is also declining still. So the public sector is taking over the private sector debt. So that will remain a problem, even in Spain, even though their public debt is quite low. So I can't see how this problem will be going away in the next couple of years unless major structural changes such as Eurobonds, bigger firewall are implemented.
Okay, Martin Koehring, thank you very much indeed.